Hello and welcome to Commodity Champions, your weekly dose of what's brewing in the commodity space. I'm Manisha Gupta and let's begin today's show with a roundup of the most buzzing commodities that we have seen in this week. And crude oil prices first, where we have seen the prices gain up by 2%, and the rise has come in after we have seen the US weekly reports show a decline in stockpiles. Well, the US inventories have declined after 7 straight weeks of build-up, and that has been supportive. The OPEC SECI also said that the non-OPEC members will boost compliance to agreed curbs, and that has been supportive. And most banks and brokerages around the world say that the prices will recover even from here in the second quarter or second half of 2017 as well. You have Citi and Deutsche Bank and even Energy Aspect saying that they are looking at prices to gain around $58 to even $70 on the higher side before 2017 ends. Well, the sugar rush is something that seems to be getting curbed right now, with the Indian prices declining to 7-week lows in last 1 week. The government may intervene to control the price rise, is what it has been saying to the cane commissioners and to the mills as well. There also is an expectation that you might see a duty-free import of 1 million tons, but that decision, of course, would be taken only after the UP election. So perhaps next week is something that we might hear on that one. In the meanwhile, look at the numbers then, and ISMA's expectation on output of sugar is at 21.3 million ton. They also feel that the consumption could be at 24.2 million tons. The opening stock for this season is 7.5 million tons. Those numbers, of course, look good, but the International Sugar Organization feels that India may need to import 2 million tons, and that is what has been keeping the markets busy. What also has seen a decline in this week has been the rubber prices. Well, you have seen decline in India on the back of poor demand, and local and global markets as well saw a decline. So in Shanghai, you saw the rubber prices decline 8%. Tokyo, the biggest market for rubber, has seen a price decline of 10% as well. The prices have also declined on expectations of increase in supply from Thailand. What has done well this week has been the gold prices. Well, the safe haven buying has taken the prices up by nearly 2%. It is the weak US dollar. And while, of course, the Fed minutes indicating a rate hike sooner than later is not so supportive for gold, but it really is the uncertainty around the US fiscal policy that has led to buying into the markets. And, of course, the Europe elections is yet another reason that you have seen buying come in here. The Indian markets, in the meanwhile, also are waiting for the sovereign gold bond Series 4. The opening of that is from Feb 27 to March 3rd, and the government, of course, has given a discount of 50 rupees per gram onto that one. Let's talk about the diamond markets then, and this space has remained muted in India post demonetization. You have seen the global markets as well watch out for various things. One, of course, is the new US government and the kind of policies that you would get from there. The second is the strength in US dollar, and third, of course, is the kind of data that seems to be coming in. If you look at the global demand, that has been tepid on the lower side, but the prices have gained up by 10% in previous year, and the expectation is that with most producers cutting production in 2017 as well, in line with the demand decline, you perhaps are going to look at prices staying at these current levels. But that was a quick recap of what's happening in the commodity markets, but we will talk in length about the diamond industry and what's taking away its sparkle. We learned that De Beers, one of the leading diamond manufacturers in the world, has cut its production by 5%. Is this really a concern? To know that, we are now joined by Nimesh Patel, who is CFO of De Beers. Nimesh, hi, good to have you. What has been the kind of demand as we start in the new year? Where are you keeping the base? How has 2016 been? And are you able to build upon that?
First of all, thanks for having me on the show. We've had a very positive 2016. Revenues are up to $6 billion, up 30% from last year. And that's built on the back of increasing demand for gem diamonds, with volumes up 50% over the last year. And all of that despite a reduction in prices of 10%. Remember, we came off a pretty tough second half of 2015, and we took some actions as a management team to tackle that, the fruits of which have come through last year. In particular, we reduced supply through managing to demand. We reduced rough prices, and we invested more in advertising to boost consumer demand. The net impact of all of that was an improvement in profitability up to $1.4 billion of EBITDA, so a very positive result.
Nimesh, how has been the growth really, especially in India, where we still are coming out of demonetization impact?
I think that's quite right. The growth driver for the global industry has really been outside of India, in particular with the US and China. In India, we've seen demand falling, but I think there are a couple of reasons for that in 2016. In particular, there was a strike of jewelry retailers earlier in the year, and I think later in the year, as you know, Prime Minister Modi announced demonetization, which had an impact in the fourth quarter.
Nimesh, the understanding is that when it comes to white goods or luxury goods, the demonetization impact perhaps could be slightly longer term. What is your sense? What are the implications that you see here?
It's very difficult to tell. I mean, we've all seen the short-term impact of demonetization, but we don't yet know what the long-term consequences could be. On the one hand, it could be very positive for economic growth, and if that's the case, we would hope to see that reflected in consumer demand for diamonds. We remain cautiously optimistic about 2017 on a global basis, and that includes hopefully seeing a return to some growth in India, but we also have to bear in mind the very significant impact of the US dollar strengthening, which is in some cases held back demand in dollar-denominated terms.
Nimesh, it's not just you, but the production levels have been cut by most producers. So are you now in line with demand estimates which have been cut in the last couple of years, and is that how you see 2017?
As I said, we intentionally reduced our production levels in 2016. So they were down about 5% versus 2015, but much lower than historic levels. Our guidance for 2017 is to produce 31 to 33 million carats, up from 27. So that's a pretty material increase, and that reflects our view of a returning demand to the industry. The target that we've set ourselves for 2017 is broadly in line with prior years, and so it just gets us back to a normalized level of production. More broadly across the industry, we have seen some new supply enter the market, not least our own Gaucho Kuei mine in Canada, which we opened just last year and is currently in the process of ramping up. But more broadly, we shouldn't forget that over the longer term, supply is very limited. There are very few economic deposits of diamonds that can be mined, and there are very long lead times to deliver new diamond mines to the industry.
Nimesh, so what is the sense on outlook now for 2017 demand, and what are going to be the important markets and factors for you to watch?
We're still compiling data to see just how 2016 fared. If we look at consumer demand, which is the ultimate driver of revenues and profitability in the diamond space, we think it's likely to be broadly in line with where we ended the year in 2015. We're looking now to see some growth into 2017, and that will depend on a number of factors. It'll depend on the economic performance in the US and in China, the performance of the US dollar versus other currencies, and in India, the longer-term impacts of demonetization.
Nimesh, a final question before we let you go. So what is the strategy that you are now taking on for various markets, especially the Indian markets?
I think what we really need to see in the industry, first and foremost, is an increase in polished diamond prices. And that's only going to be driven by consumer demand. That's why we invest very heavily in advertising across a number of different partnerships, including the GJEPC in India that ran a campaign at the end of last year. We need to continue to do that, and by driving consumer demand, we need to drive polished prices. And I think after that, rough prices will follow, but it's important that it's done in a sustainable way.
All right, Nimesh, we'll let you go at that. That's the view coming in from De Beers then, that the diamond demand is expected to kind of slow down when it comes to 2017, but then the producers have been smart and they have cut production to keep in line with that kind of a demand. Spending more money, of course, in marketing and not so much of an exploration is the view coming in from that industry. Time for a quick break, but up next, what do the Indian commodity markets need for robust growth? We will discuss that with our experts when we return.